thank you so much for coming, and I hope we're going to have very constructive sessions today as well. And to help us do just that, the Honorable Dr. Kyuil Chung, the Deputy Governor of the Bank of Korea, will be moderating session 4, titled The Future of Central Banking. So the floor is yours, so please welcome him with a big round of applause.
Good morning. I am very pleased to moderate this interesting session. We have 2 papers for this session. The first paper is about central bank swap lines. This paper is quite interesting, especially to Koreans, because we used this global financial safety net with the support of the Fed to get out of the US dollar liquidity crunch at the time of global financial crisis. The second paper is Microeconomic Heterogeneity and Macroeconomic Shocks. After the global financial crisis, we see a clear rise in inequality in wage, income, and wealth. So incorporating this heterogeneity nature into our model is probably the most important step to understand the response of macro variables to aggregate shocks. Let me explain the time allocation. Each speaker will have 20 minutes for presentation, then a 10-minute discussion will follow. After that, the speaker has 5 minutes for rejoinders. After the rejoinder of the second paper, we will have a 20-minute general discussion. Now let's invite our first speaker and discussant. Our first speaker is Dr. Ricardo Reis from the London School of Economics, and the paper will be discussed by Dr. Andrew Filardo from BIS. Dr. Reis, the floor is yours.
Thank you very much. Okay, thank you very much. Thank you for having me. It's really a pleasure to be here, and I've been learning a lot so far. This paper is co-authored with Salim Bahaj, an economist of the Bank of England. So for the first time, I think, ever, I also have to do the whole disclaimer that the Bank of England may not agree with what is in this paper. What's this paper about? There is a long-held consensus in monetary economics that's at least 2 centuries old, and that's based both in theory and in practice, that central banks should run lending facilities. That is, that there are times in which banks face funding crisis, and they should be able to go to someone who has the power to print money and are able to borrow from them in order to replace that funding in emergency circumstances. During the financial crisis, the traditional discount window of the Federal Reserve, to give one example, was supplemented by 6 other programs: the Commercial Paper Funding Facility, the Money Market Funding Facility, and several others, all of which were lending facilities run by the Federal Reserve. Now, because either these lending facilities are very old, like the discount window, or were introduced in the midst of the crisis, like the ones I just mentioned, while we have a lot of theory and practice on how they work, we have very little empirical evidence on exactly how they affect behavior and how do they affect both prices, financial prices, as well as the behavior of these banks. What we're going to do in this paper is use one such new facility, a very brand new one that started 10 years ago, in order to try to learn a little more generally about whether these central bank lending facilities work the way, say, Bagehot wrote about them 200 years ago, and in particular whether this one was effective. And I'll tell you right away the punchline: it is very effective, and indeed it works just like we were theorizing 2 centuries ago and as we do in our models. But first let me tell you what are these swap lines. These swap lines were created in 2007, and they consist essentially of a contract whereby a foreign bank, I'm going to make it for concreteness the ECB in this talk, would go and borrow dollars from the Fed, let's say $1 million from the Fed, and it's a swap line because the ECB would then give it the corresponding amount in euros to the Fed, which would then be returned to each other 1 week after when the transaction was closed. They were of as you see, they grew to very large amounts between the Fed and 6 central banks: the Bank of England, the European Central Bank, the Bank of Canada, the Swiss National Bank, and the Bank of Japan. Sorry, 5 central banks, 6 with the Fed. Okay? They grew very large during the crisis, but they continued during the European crisis, and a little bit after, they also grew quite a bit, and they've been standing facilities since 2013. That is, any of these 5 central banks can in principle go to the Fed and borrow up to an unlimited amount, just as in the discount window. Okay? So they were very large. Moreover, they've also grown beyond the Fed. These are just the Fed swap lines. back in January 2007, there were these small swap lines between, you can't read, but hopefully you have the slides in front of you, between Vietnam, Cambodia, and a few countries. Then we had the Fed swap lines emerging. And then by 2015, that is in the last 5-6 years, the People's Bank of China signed more than 100 swap line agreements with different central banks of approximately 2 trillion in terms of committed dollars right now. So right now we have this very complex network of central bank swap lines across many different banks. So this is the Fed dollar swap line. The euro swap line is here quite big. So for instance, the central bank of Korea is here as a swap line with both China, Australia, as well as the ECB and so these swap lines went from essentially being inexistent, didn't even exist for the Fed before 2007, to nowadays being so large that I found this wonderful quote while we were writing this paper 6 months ago from the Federal Reserve Bank of India governor, who is not in one of these networks and complains and uses strong words of being in apartheid because he's not part of the swap lines. Something that didn't even exist 10 years ago, and now you feel dreadfully left out if you're not part of it. So what I'm going to do in this paper is try to understand how these swap lines work. So let me start with exactly explain to you in detail the details of the contract. Here is the contract. Again, using for concreteness the ECB and the 1 week swap line. There's also a 1 month swap line. The 1 week was where almost all of the volume went, so I'm just going to describe that for concreteness. The way it works is that the ECB would go to the New York Fed and borrow $1 million, receiving in return exactly $1 million in euros to hold as a deposit against that loan. This was done at the spot exchange rate at the time in which we signed the contract. 1 week later, the ECB had to pay back the dollars to the Fed and would get back the exact euros that it had deposited the Fed. That is, the exchange rate at which the settling of the swap was done is at the original exchange rate, not the final one. In other words, there's no exchange rate risk here at all. The settlement happens at the same exchange rate. Now, the Fed charges an interest rate in dollars that debits from the ECB account, and it sets that again at the start as being equal to the overnight index swap OIS 1 week rate, which is based on the interest on reserves, plus a spread, 50 basis points. It used to be 100 basis points, then it changed to 50, as you'll soon see. Okay? What does the ECB do with $1 million? It doesn't use them to intervene in foreign exchange. It doesn't use them to deal with current account imbalances. No, the deal with the Fed is that it will lend them to a European bank charging the same rate that the Fed is charging it. So the ECB is making no profit out of this. But the ECB's role is to, one, assess and collect the high-quality liquid assets that serve as collateral, determine who is eligible, and collect the payment. That is how the contract is written. That is, what this is de facto is the Fed lending to a European bank, but using the ECB as an intermediary in order to get the credit risk and do the monitoring and pick the collateral that it wants. That's the way the contract is written. Okay? Therefore, you see that this, right away, this is a U.S. monetary policy. Dollars get printed. The euros that get printed never enter circulation. They just get deposited in the New York Fed and get returned. Okay? At the same time, there's no exchange rate risk or interest rate risk. There's only credit risk, and that credit risk lies solely at the ECB. It's a U.S. monetary policy with the ECB being hired as the agent to deal with all of the credit risk. It is a basic function of the central banks, for the Fed is providing liquidity when European banks really want liquidity, they really want dollars, and the ECB is performing its basic function of judging which banks and collateral are good among the banks that it supervises, that it regulates. Okay? So note that the swap lines, unlike there's unfortunately quite a bit of myth around it, especially in the press, they are not a substitute for IMF loans. They're 1 week facilities. They're liquidity facilities. They're not exchange rate interventions. They're being lent to the European banks. Okay? And they do not come with nationalization of risks or bailout of European banks, or they only do so insofar as any lender of last resort does, nor are they the U.S. subsidizing the Europeans by giving them cheap dollars. Actually, quite on the contrary, the U.S. is charging over OIS a spread and yet bearing no credit risk. So at least relative to the discount window, the Fed is profiting rather than making a loss in that regard. Now, you can ask, though, why why do it this way? Why not have the Fed lend directly to the Eurozone banks through the discount window? Several reasons. The first one is stigma. We know there's a lot of stigma associated with the discount window. The way the swap lines are arranged, even today in 2018, I do not know which European banks got the funds from the ECB. Secondly, the ECB monitors these banks, so knows much better which ones are solvent and illiquid solvent but illiquid to follow Bagehot's principle. The Fed would much rather have the ECB bear the credit risk and do the monitoring. Moreover, you could have subsidiaries of the European banks at the Fed show up at the discount window, but for that they need to have quite a bit of collateral. The subsidiaries don't have that collateral. The Europeans don't like having all this high-quality liquid collateral being transferred from the head office, say in Frankfurt, into the tiny Deutsche Bank subsidiary. So in all sides, they all seem to be happy to do it this way as opposed to the discount window. Yet there's another alternative. Why is it that the Eurozone bank, let's say Deutsche Bank, does not simply borrow euros from the ECB, uses those to buy the dollars it wants, and then goes to the foreign market to swap out whatever currency risk it wants? After all, the spot on the foreign markets were always open. There's no sense, you read again a lot of the press that says you couldn't get dollars. That's just silly. There's an enormously big dollar. You can buy dollars at any moment. There was never any issue with buying dollars in either swap or the foreign market. Well, that alternative leads me to the second point of this paper that I'm going to make. Here is a result, here's a theory considering precisely this alternative of what if the Eurozone banks borrow the euros from the ECB. This proposition is based on an arbitrage argument, so I can state the proof for you right here. Imagine the following arbitrage trade. The Eurozone bank, the Deutsche Bank, would borrow dollars from the ECB swap line with the Fed, and thus pay the swap line rate, IS. With those, it would use those dollars to buy euros in the open market at the spot rate, and at that time buy a 1-week forward contract such that it gets the euros back into dollars to pay back the swap line. What does this European bank do with the euros? Well, it goes back to the ECB and says, I'm going to deposit them with you. So this bank is borrowing dollars from the ECB and depositing euros at the ECB. There's no counterparty risk of any kind. I'm borrowing from their facilities and depositing in the other. Therefore, this is a no-risk, no-arbitrage trade. Okay? Even the collateral that you put at ECB, well, but you can offer then the deposits that you have at ECB as the collateral. As a result, it must be that the swap line rate must be high enough such that you cannot do this, otherwise you turn into a money pump. From there, it follows right away the following result. Letting X be deviations from covered interest parity, deviation from covered interest parity, that is the price at which you can buy these forward contracts to insulate yourself from the exchange rate risk, is bounded above by the swap line rate plus the differential between the interbank rate and the deposit rate in the foreign country or the recipient country. Okay? That is, you cannot get a forward contract that's too bad, otherwise you just go and get the dollars from the ECB, or from the Fed via the ECB. Okay? Now, the nice thing about this proposition is that note that there's two. One, it's a very tight result, and it's a tight result that should be very familiar to monetary economists. It's exactly the same logic that says that the discount window puts a ceiling on the interbank rate. It's literally the same logic. Okay? It has a virtue over that, which is that you would only have, if it was a discount window result, that the discount window minus the interbank rate put a bound on this. But you have not just this variation from the Fed, but also the variation from the foreign central bank. And you have this applying to the different contracts, the different X's, the different CIP deviations across different countries. And that gives me a lot of variation with which to explore this, to test whether the ceiling result is true. In particular, look at what happened to this in red is the European CIP deviations. Before 2007, the CIP deviations were essentially very close to zero. That's why we didn't need any swap line contract. For reasons having to do with regulation, which I won't get into here, a CIP basis emerged post-2007 and 8. Once a CIP basis emerged, a need for ceiling in it emerged to stem, again, funding risks and funding costs, which explains why the Fed, the ECB, and all the central banks felt the need to introduce these swap line rates. Okay? Here's the ceiling introduced according to my proposition. Here's the actual deviation. You see here the big shock of Lehman. The ceiling here is introduced, but the swap line is still under very limited amounts. Here it becomes an unlimited amount facility, so the ceiling really starts applying in force here. I'm going to use note that the ceiling varies for two reasons. These reasons has to do with when the ECB changed its policy rate, the MRO rate, relative to the reserve rate. This is the Fed on the 30th of November 2011 changed the swap line rate from 100 to 50 basis points. Why did it do that? It did so after 6 months of negotiations, especially with the European Central Bank, but also the foreign banks. It was a difficult negotiation. They'd had to figure out how to set up the program for it to be a permanent program. And they lowered the rate at that date because that's basically when they agreed. The date was essentially exogenous. Nothing much was going on in the basis in the weeks before. The amount is also mostly exogenous. Why did they go from 100 to 50? We can now go and read the minutes, and it's very curious because the discount window rate was 75 basis points at that point over the federal funds rate. And so Stan Fischer says we should set it at 75, and Ben Bernanke says, oops, I agree with the Europeans to do it at 50. And then Stan Fischer says, well, that's your problem. And Ben Bernanke says, I don't want to lose face. I mean, again, we can read all the minutes. And so there's a bit of a negotiation, and in the end they say, fine, let's do it at 50. And anyway, we're going to lower the discount window to 50 in a few months. Okay? So it's relatively exogenous, both the size of the change and the timing of the change. So what I can do is use this in a different diff strategy. I can look at the swap line currencies in blue, this is the Cip Deviations, versus other currencies. I've already told the 5 swap line countries. My others are the Australian dollar, the Danish krona, the Swedish krona. There's 5 of them, and I forget which ones they are. It's in the paper, sorry. There's 2 other Scandinavian countries. Finnish krona. Anyway, sorry. Okay. I'm missing one. Here is when the change happened. We do a window of 1 month so that not to be biased by end of year results, because there's a little seasonality in the CIP, but we can include that. And what you see very clearly visually is that the CIP falls for the swap line currencies when there's no change for the other currencies, consistent with you lowering the ceiling, and you have the average CIP deviation changing. This is even more clear if you look at the distribution. Here's for the swap line currency distribution of the CIP deviation, in white before, in green before, in white after. For the non-swap line currencies, nothing changed between January and November. For the swap line currency, you see that all that mean effect I showed in the previous figure comes from cutting the top, just like a ceiling should. Essentially, no longer would we have CIP deviations above 50 basis points because you cut them completely. You can do this in a regression sense just to tell that it's significant and it's driven by the 10th percentile. And the effects are that a 50 basis point reduction in the ceiling lowered the average CIP basis by approximately 18 basis points, and at the 10th percentile by as much as 27 basis points. So a very large effect of a discount window, a lending facility rate on the interbank rate, exogenously set. Now, I also have domestic variation, like I told you, and I can do that through a regression, regressing the basis on the ceiling, now both with the swap line change as well as the domestic variation, driven by ECB policy, that is these changes here, or that is this term here. Oh, I have the currencies here, so these ones, Australian dollar, New Zealand dollar. New Zealand, I was missing New Zealand. Okay, sorry, that was the one I was missing. And the estimates are now to be very similar. Okay, so again, roughly 20 basis points was the fact of the change. You can then say, let me look at quantities. This is how many dollars the ECB auctioned. This is how many dollars the BOJ auctioned during this time. Now, because these are full allotment, that is, it's a standing facility, the supply curve is horizontal. So I can just do ordinarily squares of quantity on price, and I'll estimate the demand curve. And so that's exactly what I do. And I get the elasticity of the quantity to the CIP basis is indeed, as you'd expect, positive. The bigger the CIP basis, the more banks show up and wanting to borrow dollars from the swap facility. Even more curious, I can estimate the same elasticity from when European banks borrow euros. And remarkably, the elasticity of demand for liquidity in euros, 1.6, is actually pretty similar to the one at which they borrow dollars. Again, re-emphasizing the point that the swap line is just like the discount window and even has similar properties to it. Now, does this matter? That is, does this matter for macro or for choices aside from this price effect? So the next contribution is a model, which I'm going to skip, but which has the following two, I think, fairly obvious predictions. I'm running out of time, so I'm going to completely skip the theory, which is that if you lower the swap line rate, and I'm a European bank who relies on dollar funding from the US money markets, as was the case in 2008, and that funding disappears, if I have a swap line rate insurance, you're insuring me against the funding risk, that's this Xi shock. I'm going to invest more in dollars because I have less risk because you've given me insurance. Okay? With a cheaper swap line rate, European banks would be more eager to invest in dollars, to invest in the US market. So here's my first empirical strategy. I'm going to look at banks, again, triple difference and difference, in the countries with the dollars, again, German banks versus New Zealand or Australian banks, before and after the swap line exogenous 50 basis point change. And then I'm going to look within these European banks, their investments into dollar corporate bonds versus euro corporate bonds. Because I have data on all their corporate bonds holdings. I have a Bank of England co-author with access to confidential data on all these holdings. Okay? So it's a triple difference in difference. And here's what it looks like. In blue is, again, a European bank before and after the swap line change, and this is how much it invests in dollar bonds minus euro bonds. And note how they shift their portfolio towards dollar bonds in a way that the non-swap line countries did not. So again, here's a diff and diff, in that you see that I'm now encouraged to go and put that into. Again, you can do regressions in the interest of time. It's a triple diff and diff. And just to tell you that we control for all possible fixed effects at the bank or the currency level, maybe where there's something about the European banks, or maybe there's something about the particular bonds that are issued in dollars. We have very aggressive fixed effects, and you end up having essentially the same coefficients. Strategy 2, though, you say, well, fine. So they shifted all these European banks with a swap line shift into dollar bonds. But does this matter in prices, these quantities? So I'm going to do a diff and diff now because I know the bonds to which they shifted, I'm going to see what happens to these US dollar bond prices. And so I'm going to compare them before and after the swap. And the way I'm going to do it is essentially through, I'm going to match these dollar bonds using a nearest neighbor procedure, but anyway, I'm going to match them to an equivalent European bond and see what happened to the price. And what the estimates show is a very large effect whereby the yield on US dollar corporate bonds as a result of the swap line change fell by 9 basis points. A very, very large effect if you think about it. Right? You put this discount window and guys are happy to invest into these bonds, into this lending facility. Okay? Note, by the way, that this shows why the Fed likes this program. This prevents fire sales in the US market, prevents these European banks from unloading all these corporate bonds of the US when they lost the US funding. They now have the insurance of the swap line. They invest more in the US in the first place. Last empirical strategy, last thing in my last 30 seconds, we then also look at what about the Europeans' interest? Well, let's look at the stock value of the European banks, where again I'm going to do a triple difference. So again, before and after the swap line change, swap line bank versus non-swap line bank. And I'm going to look within the, say, German banks, those that have dollar investments versus those that do not. Because I would expect the ones that don't invest in the US not to be affected with a swap line change. And again, the diff and diff shows that if you're a European bank that had a US presence, you had excess returns accumulated over the next 3 days of 2.5%. Whereas if you were a German bank without a US presence or a Norwegian bank, you had no excess returns around this time. There's a caveat. Anyway, I won't do the caveat. I'll let them discuss in the interest of time. But conclusion of this paper, first, the swap lines are very large. They're here to stay. There's I think almost no research on them. We made 3 points. First, the swap line is the twin of the discount window, both in the features of the contract, as well as in terms of the effects that it has on investment. And this allows us to learn something about lending facilities. Third, that they put a very sharp ceiling on CIP deviations, and we found very strong evidence that indeed the ceiling operated by truncating the histogram and then lowering the average CIP deviation. And finally, that the swap lines through these 3 complementary strategies encouraged investment by European banks, or could be Korean banks if it was a swap line between Korea and the US, to invest in dollars ex ante, preventing fire sales exposed, because we see this portfolio tilt that's also matched in asset prices as well as in bank stock prices. Thank you.
Thank you, Dr. Reis. Now, Dr. Filardo will continue with this discussion on the paper.
Well, thank you. It's a great pleasure to be here and to be back in Korea. And I'd like to thank the governor and the Bank of Korea for putting on this excellent conference and for putting together this excellent session. Professor Reis has a great paper. I recommend it to everyone, especially this descriptive part of how these swaps works. It's particularly clear. And this issue is of prime interest for this country, for this region, and I think for the global financial system. It's this question that central banks and I think investors have been facing for a long time, which is why don't we have deep swap markets in a number of currencies around the world? Often they have to rely on U.S. swaps into one currency and then from that currency into another. And this lack of deepness in these markets is particularly important given the increase in cross-border foreign currency flows which occur. So this paper is well-timed, and it's a very nice contribution to the discussion that's going on internationally. The authors have a nice way to think about FX swap markets, relating it to the discount window and how interventions in the swap lines might work. They present very strong evidence that these swap lines are, the central bank swap lines are powerful and they work, and it builds up this case that central banks have balance sheets that are incredibly useful in certain times. They're powerful, but sometimes with that power you have to worry about overburdening central banks with a lot of activities that might take them away from their regular mandates or primary mandates for financial stability and financial stability, price stability and financial stability. And so the question that the authors leave us at the end of the paper is, should central banks be playing a more prominent role in these swap markets? And so that's where I want to make some comments. So what role could central banks play? To understand the possibilities, I think we need to understand what's been driving the swap market. And so this is the U.S. dollar cross-currency basis swap spread. When these numbers are below zero, it says that U.S. dollars are costly to hedge if you've taken positions, say, out in Asia on investments in U.S. dollars, and you ultimately want to swap them back into local currency. And what's key here is to realize that there's three periods. The first period is in the pre-GFC, pre-2008 period, where you have CIP holding. This was the heyday of CIP, when we thought that these markets, FX markets in particular, were incredibly deep and liquid. And then we learned after 2008 that it just ain't so. In the second period, we had a number of banking crises which led to counterparty risks that rose amongst the main arbitrageurs in this market, and those were the GSIBs, the globally systemically important banks. They had a play. There was counterparty risk in terms of understanding whether these contracts would be fulfilled, and then this risk had to be priced, and that's why you saw an opening of this of the CIP gap. It happened in the immediate wake of the GFC, when the U.S. banks and other banks around the world were having trouble, but also again when the European banks had trouble in 2012. But by the end of 2013, it looked like the CIP gap was going back to zero. And so we thought we were going to head back to the old normal, which was the pre-GFC period. But then what we found out is that the new regulatory regime, amongst other things, seemed to have a persistent and a large effect on the CIP gap. And so what was happening there is we went to a new normal, or maybe not, maybe it will fade with time. But this new regulatory requirement basically imposed higher balance sheet costs to financial institutions that were dealing in these markets. And this led to less than perfect arbitrage between the spot and swap markets in this new regulatory environment. And so for my first comment on the paper is, does the model need to be a little bit more sophisticated in terms of capturing these different drivers? The regression analysis is over this whole 2008 to the more recent period, where there is really two regimes of what's going on in terms of the drivers of the CIP differential. And what's important now is this new regulatory environment, whether it's Basel III regulations on capital, FSB initiatives to help increase the resilience of the global financial system. The bottom line is that these new requirements have increased the balance sheet costs, as I mentioned, of these traditional arbitrageurs, and this has led, and this was done for good reason. It was basically to make sure that these financial institutions were internalizing the social costs they had from making their decisions. We might think that the pre-GFC period was the more odd period, where we allowed banks to take on what could be considered risky trades, in particular with the increased flows of foreign currencies across international boundaries. That this led to balance sheets that were much more fragile and much more subject to risk. But the unintended consequence of these regulations, which were to improve the resilience of the financial system, they increased the cost for institutions to do intermediary activities and to become market makers in these swap markets. And in particular, the leverage ratio has played a very important role, because the leverage ratio has basically limited the room for players in this market to net across various transactions amongst different counterparties. And I'm going to get back to that in my recommendation at the end of my comments today. But it also should be noted that we're here at a central bank, and unconventional monetary policies played a role in driving some of these CIP gaps. Basically, the unconventional monetary policies, especially in the United States, made U.S. assets particularly attractive to foreign investors. And these foreign investors took these positions, and they needed to swap these positions. And at the time, there was less supply of these swap arrangements from the GSIBs. We had increased demand, and that's what caused some of the dynamics. Should note that the Aussie spread is positive rather than negative, like many of the others, and there's a special story that you can read about in some of the BIS documents that are on the web. So in a picture, what was happening in the pre-GFC period, we have these GSIBs providing arbitrage services to this market. You have a very elastic supply, and demand is basically shifting around, and the CIP gap is remaining close to zero. In the post period, basically for period 1 and period 2, you have this upward sloping supply curve where you have to pay more to get these services provided, take on these various risks. And then as demand shifting around, you're getting the CIP deviation moving around. So it's not a tax or anything that's going on. It's just these risks are being priced in the market. And so what's the role for central banks? As the paper sort of suggests, that a more prominent role by central bankers might be helpful. And this raises several questions whenever you ask the government to involve itself in markets. Is it going to be a good thing? And so first, one has to establish the cost of the CIP gap. When I talk to my banker friends, they basically say, they shrug their shoulders and say, yeah, it's there, but we don't pay too much attention to it. That was initially the case. Now they're trying to figure out how to make money off it. But it doesn't seem to be of first-order importance. It seems more of second-order importance, at least to the bankers. But we need a model that really writes down exactly what the welfare costs are. Is this more like a Tobin tax that kind of multiplies in terms of its distortions, or is it something that just really reflects that there are scarce resources in terms of risk management, and that those things need to be priced, and this is being priced now? There's another question of who should address it. Professor Reis has talked about the U.S. Discount window analogy, and the U.S. might get involved, or the European Central Bank might be a counterparty. But it's not just central banks that get involved in this activity. Of course, you have global, regional, and local banks, asset managers, hedge funds who can come in and arbitrage this market, especially if they're not subject to these new regulations. Same is true for international financial institutions that are not subject to Basel capital requirements or leverage ratios. And some of these financial institutions are starting to move into this market. But it's incredibly hard because there's a lot of legal requirements that have to be changed in these institutions, and mandates that have to be changed to allow them to get into this market. And it's not clear how long the CIP differential is going to remain in place to make that investment secure. Let me move on. And we have non-U.S. central banks, such as central banks in emerging markets, who regularly get involved in some of these markets. They already play a role, but they tend to play the role of the market maker of last resort rather than the market maker of first resort. And I wonder to what extent, if this suggestion by Professor Reis that somehow that central banks should provide these swap lines on a more regular basis in normal times, would that help to develop these deep swap markets, or it would hinder their development? I think the evidence from Latin America suggests that when central banks remove themselves from providing a lot of interventions into markets, that we saw private market swap arrangements developing and those institutions becoming stronger. And so there may be a case to be made that this involvement of the central bank in these arrangements, certainly in the first line of defense as market makers, may be counterproductive in terms of coming up with a true market solution to what's going on. There's also this problem of monetary politics, of how one justifies a central bank with a domestic mandate getting involved with non-domestic issues. Professor Reis suggests that there's some spillbacks in terms of fire sale concerns, but I don't think most central banks think about this in normal times as the swap arrangements as being of first order importance. So if you had a European bank, and European banks issue a lot of dollar claims out here in Asia, is it the Fed that should be providing these swaps? Is it the ECB because their banks are making providing the swaps? Is it the investors out in Asia because they're the investors, or is it the ultimate investors who deposited their funds in the banks that are then invested? So I think there's deep questions about whether this is a feasible option for central banks given their domestic frameworks. I've already talked about the last line of defense. And let me just end because my time is up. We need to think about more market-based solutions. Many might be surprised that there's no central counterparty mechanism for FX swaps. And certainly this would go a long way to coming up with a market solution. Where CCPs are private groups that get together that interpose themselves between these transactions and help to ensure that these transactions are good. The problem with the current regulations is that if you have bilateral transactions with different counterparties, you have to put multiple layers of capital and you have to worry about the leverage ratio. But with these CCPs where the netting can be done and these regulations can be dovetailed with the operation of the CCPs, where the contracts are maybe more uniform, you can reduce the cost of doing this kind of risk trade and get the benefits of building up a much stronger private sector solution and not have to rely on a particular bank at a particular time to make a particular swap line arrangement. The benefits of this kind of solution is you reduce the moral hazard associated with central bank intervention. You eliminate political risks in this market. If the finance minister doesn't like the kind of swap lines that the central bank is providing, that can cause uncertainty at the wrong time. And the strong market orientation of these CCPs would help to generate this general trend towards a much more improved or strengthened global market infrastructure. Since I see the chairman getting a little nervous here, I better stop. But I think this is a great paper. I think we need to have a better understanding of both the market alternatives as well as the central bank alternatives and the cost of these CFP differentials. And I recommend that everybody read I think it's section 2 of the paper. It's incredibly clear. Thank you very much.
Thank you, Dr. Filardo. So could you reply to the comments?
Sure, absolutely. Mostly to thank Andrew for this for a very informative discussion on the many issues that arise here. I'm going to make 3 points only just to clarify or to expand a little bit on what Andrew said. First point on the different regimes. So we end the sample at the end of 2015 because the regulations start in 2016. So on purpose we ended the sample before so that we wouldn't have the other regime. But even then, the bulk of the empirical results are based on this diff in 2011. So much before even regulations were being discussed. So I'm not worried about that in that sense. Meaning it's about the second regime, not the third, this paper at least. Even though obviously I would like the points to apply even to today, but it's really about that time. Second point on the CIP model. So I agree. I mean, there's very exciting research going on. I just came from another conference where Darryl Duffy was presenting a whole paper on where the CIP comes from, and he was claiming it has nothing to do with regulation, has to do with funding and value adjustments. So I know there's a very spirited debate in this literature on exactly what's driving the CIP, and I couldn't agree more that understanding it, what welfare or other losses come from it is first order. In some ways, I'm just saying there's a ceiling to it. There's some CIP that's being driven, and the central bank happens to put a ceiling on it. The ceiling is important insofar as, just like with the discount window, when there's a crisis, it's important that you stop it, I think. But why does it fluctuate within it? The swap lines, I don't think, have an effect on it beyond the effects that I've shown. And so essentially we punt on that question, and I could not agree more that that's a first order question to then try and understand the CIP per se. Our paper in some ways was understanding the swap lines, and the CIP was a nice side effect that it happens to affect on CIP, but there's a lot of work to be done on that. A third point, which I think is a especially interesting point, more on the swap lines and what to do next and how to think about this next, is the point Andrew put very nicely, which is why the central bank? There's an easy answer to that, which is, at the end of the day, this is about foreign banks wanting dollars. There's only one person who can print dollars, and that's the central bank. the central banks are the ones who can give liquidity facilities in some ways, because they're the only ones who, if there's big fluctuations in demand, can really supply the thing very quickly. So that's just a classic Bagehot, Thornton, 19th century explanation for why it has to be the central bank giving liquidity. But that only goes partly because, of course, the demands from these foreign banks aren't as big as the ones from U.S. banks, so you could think private insurance agreements could probably do a lot of the way without you going to that extreme version. And so there's an important question of why. I mean, there's some discussion of whether the IMF should do this. The IMF has some documents kind of discussing maybe they should get into this business or not, I think. But I think they're lacking a little bit of papers like this, understanding what the swap lines does. But I think that's an important point. But I think there's even more interesting coordination. So from the perspective of a reaction I had when I presented this in Europe 2 weeks ago was, oh, we shouldn't have these swap lines because we all know, and the person asking knew, that European banks invest way too much in the US, that exposes them to these funding imbalances, and that creates these big crises. And so here we are providing insurance to something that this person was deeply convinced was an inefficient overinvestment of Europeans in the US. Again, all these German banks buying US mortgage-backed securities was supposed to be a bad idea or not. Maybe, maybe not, but I think that's exactly the questions that you're raising, and here's an example of this. I mean, we are providing insurance for this cross-border funding. It goes back to whether we want to have global banks or national banks, and I certainly thought that maybe, I still think that global banks are a good idea, but there's a lot of people nowadays who think that maybe we should go back to national instead of global banks, in which case the swap lines are not so useful. But if you are going to have a global banking world in which European banks invest in dollars, then you're going to have to develop liquidity facilities, just like we did when domestic banking markets emerged and the Federal Reserve 100 years ago, as opposed to local and state bankings. A related question on that welfare is the coordination. I think it's very interesting to think about, and I think there's a lot of interesting theory to write, because it's a discount window where one bank decides the collateral and the other one decides the terms. And so and they both benefit and lose in terms of the interest rate. I think for the people who are better theorists than I in the audience, I think it's actually a super fun, interesting theoretical game to be playing to these two central banks in terms of how are the swap line terms actually set or not. And the current contract doesn't, still leaves a lot of room for gamesmanship. And I think that's why the Fed or the central banks are a little weary of letting the central bank of India or others. But I think those are the first order questions that, at least in the theory, one has to answer, following up on what you said, the welfare and the coordination of the terms.
Thank you. Let's move on to the second paper. Our next speaker is Dr. Greg Kaplan from University of Chicago and Dr. Jinill Kim from Korea University. Discuss the second paper.
Great. So thank you very much for inviting me here. It's been great to be part of this wonderful conference. This talk is based on some joint work with Gianluca Violante. So in the last 5 to 10 years, there's been an explosion of papers that have used a framework that I refer to as HANK models. So HANK is an acronym. It stands for Heterogeneous Agent New Keynesian Models. The HA part, heterogeneous agent part, refers to the existence of a large set of households in these models. These households are heterogeneous because they face labor market risk, and they can save in only non-contingent assets. This means that in these markets they have, in these models, there's non-trivial distributions of wealth across households. The NK part of the acronym stands for New Keynesian Models, and by that I mean models with nominal rigidities and monetary and fiscal policy rules. Now, in the last 5 years or so, there's been an absolute explosion of models with these features. Probably the two earliest papers were papers by Ricardo. And they've been used for a number of things, and one of the reasons why they've grown in popularity is that they allow for a joint analysis of distributional issues and monetary issues, which are two sets of questions that I think until recently had been largely studied in isolation. What I want to do today in my talk is to summarize from this literature, from papers I've written and from papers that others have written, what are the key lessons I think that this new literature has delivered in terms of ideas that are relevant for how we think about monetary policy. And then I want to talk about where I see HANK models fitting into central banks, to day-to-day operations of central banks, the question that I get asked a lot. So I'm probably going to run out of time. So let me summarize what I think where I see these key lessons that we've learned. So the first set of lessons pertains to the determinants of household consumption behavior in the economy. One thing that's come out of HANK models is the idea that in thinking about fluctuations in aggregate consumption, changes in household disposable income are as important, or if not much more important, than changes in interest rates. The second key lesson, which is a direct corollary of that, pertains to the transmission mechanisms of conventional monetary policy, changes in short-term interest rates. And here I think former Governor Shirakawa has summarized very accurately yesterday the state of thinking prior to Hank models. And I'll quote, he said that monetary easing is about bringing forward future demand to the present. In other words, intertemporal substitution. And that is definitely the ideas that lie behind monetary transmission in representative agent New Keynesian models. One of the key lessons from heterogeneous agent New Keynesian models is that indirect effects that affect household consumption through changes in the labor market, are at least as important, if not much more important, than direct effects that arise from intertemporal substitution. That's differences in monetary transmission. The third lesson is that in models with heterogeneity, the door is open to other transmission mechanisms that arise through redistributive effects that exist because of the vast heterogeneity across households in marginal propensities to consume and in the structure of different households' balance sheets, with some households being net lenders and some households being net borrowers. And whereas in the past I think these redistributive effects have typically been considered a sideshow or second-order effects relative to intertemporal substitution, I think one of the key lessons coming out of Hank models is that these are equally as important, if not more important as well, than intertemporal substitution. And finally, the last lesson, which is probably the most controversial, the elephant in the room, and the one that I think is probably the most important lesson coming out of Hank models, is that whether you like it or not, the inconvenient truth is that central bank actions are not distributionally neutral. They do have distributional consequences, and at least my view on this is better the devil you know and understand how those distributional consequences play out. I think Hank models provide a way to be able to study those issues. What does that mean for where this class of models is useful in central banks? I think first and foremost, it's a set of well-grounded frameworks that can be used for thinking through policies, particularly the distributional and redistributive consequences of those policies, and for providing a mechanism with a clear micro-foundation for communicating some of the thinking behind different types of central bank actions. The two other sets of areas where I think this class of models has been underutilized in policy circles, but I see a huge potential. First is as a guide for how to think about the massive amounts of microdata that we now have access to, particularly from households, but also from firms. Hank models provide a framework and a lens through which to view some of these data, and I'm going to talk about some of the examples of that. And finally, I'll also show that I think these Hank models provide a way to go beyond just aggregate time series, and by using cross-sectional data as a tool to identify the sources of distribution of disturbances that hit the economy. And I'm going to give one example of that. Okay, so why Hank models? So Hank models were born out of the observation about representative agent models, that inside representative agent models, consumption is determined basically by an Euler equation, and as such, this means that consumption is extremely sensitive to interest rates, but basically very insensitive to transitory changes in income as a result of the permanent income hypothesis. But this view of consumption is vastly at odds with lots of microdata. So first, microdata reveal very weak sensitivity of household consumption to changes in interest rates. And if you take a deeper look at where this insensitivity comes from, it comes from all parts of the wealth distribution. At the very bottom of the wealth distribution, there are what we call poor hand-to-mouth households, who basically don't hold any assets, so are not sensitive to changes in interest rates. Further up the income distribution are what we call wealthy hand-to-mouth households, who might hold lots of wealth, but very little in the form of liquid wealth that is affected, or at least affected in the way that conventional models think it should be affected by changes in interest rates. And finally, at the very top of the liquid wealth distribution, you have lots of households who are exposed to changes in interest rates, and they're offsetting income effects from changes in interest rates that are typically ignored in representative agent economies. At the same time, the microdata reveal large consumption responses to transitory changes in income. Again, because of hand-to-mouth households who have high MPCs, but also households who fear being hand-to-mouth at some point in the future because of the precautionary motive and the concavity of their consumption functions. What Hank models do is provide a set of models that gives consumption behavior that's more consistent with this microevidence. So for example, I have a preference for two-asset Hank models. These are models that have both liquid and illiquid wealth. This is an example of some wealth distributions that arise from those models. They capture key features of the wealth distributions in developed economies, extremely skewed both liquid and illiquid wealth distributions and large numbers of hand-to-mouth households. They deliver consumption responses that are very much less sensitive to direct changes in interest rates because of the mechanisms that I've just described. And they deliver marginal propensities to consume that are much, much closer to the empirical evidence than in the data compared to representative agent New Keynesian models. But not all is great with Hank models, and I want to take a step back and mention some issues. So with Hank models, the devil is in the details. There are a bunch of assumptions and issues that one has to confront that are essentially inconsequential when looking at the world through a representative agent lens that can matter absolutely tremendously in Hank and heterogeneous agent models. So you can see this as a bug or a feature. I see this as a feature because it forces us to confront microdata on how these forces actually tend to play out. So let me describe the key ones. So the first and most obvious one is because of the failure of Ricardian equivalence, it's basically impossible to think about monetary policy issues independently of fiscal policy. Now, again, that was convenient in representative agent models, but it's just not a fact of life in the world, and that's something that we have to deal with in heterogeneous agent models. Fiscal policy interacts very strongly with monetary policy. The second, and this is a consequence of how output fluctuations work in New Keynesian models, but also in fact, all models that I'm aware of in which aggregate demand fluctuations affect aggregate output, that profit fluctuations in the corporate sector play a big role in those movements. Conveniently, in representative agent models, we don't have to take a stand on who are the claimants, the residual claimants to those profits. But in heterogeneous agent models, as in the real world, there's a huge amount of heterogeneity and exposure to fluctuations in profits, and that's something that we have to think about, and data can help us in. Thirdly, and this relates to some of the things that Bob was talking about in his talk yesterday, as we all know, there's no unique discount factor for pricing contingent claims in heterogeneous agent economies, so we have to take a stand on who is making intertemporal decisions in the corporate sector. That's related to the second point. And finally, and this is an area where the heterogeneous agent models have not made much progress yet, is that the fluctuations in labor demand themselves disproportionately impact on different types of households. So in typical representative agent models, even in heterogeneous agent models at the moment, we mostly assume that the demand for goods is met by an increase in demand for labor, but in heterogeneous agent economies, it might be very different types of people who are impacted by those movements in labor demand. Of course, there's also difficulties in computation. I'm not going to talk about those. Okay, so with all of those difficulties, what does it buy you? Well, I think the main thing it buys you is that different economic forces. So the question that I get asked a lot is, how are heterogeneous agent models different from representative agent models? And the answer that we give in this paper is that, well, it depends on what you mean by different. Okay, so as a starting point, I want to think about how aggregate consumption responds to a particular specific aggregate shock. And the answer is going to be different depending on which shock that we think about. I want to draw a distinction between three different notions of equivalence between Hank and Rank. In the paper, we give precise definitions of what these notions mean. First, I'm going to say that the consumption response to a particular shock is not equivalent between the heterogeneous agent and representative agent models if they generate different impulse response functions to the same shock. Okay, an example that I'll show you in the next slide is a monetary shock. As an example of non-equivalence, the Hank and Rank models deliver different size effects of a short-term monetary stimulus. The second type of equivalence I want to describe is weak equivalence. Weak equivalence is when the impulse response function to the same shock looks the same, but for different reasons, potentially for different reasons. So weak equivalence was, for example, what was uncovered by Crises and Smith in their seminal work, and an example is a TFP shock. The impulse response functions look very, very similar in heterogeneous agent and representative agent economies. The third type of equivalence I want to think about is strong equivalence. Strong equivalence means that the impulse response functions look the same. So if I were to hand you output from the model, from the representative agent and heterogeneous agent model, just like in weak equivalence, they would look the same. But they'd look the same for the same reasons. In other words, the economic mechanisms that are driving those economies would be the same. An example there is a discount factor, I'm going to say patience shock in representative agent heterogeneous agent models is an example of strong equivalence. Now, telling the difference between non-equivalence and weak equivalence, is kind of straightforward. You just need to look at impulse response functions. Telling the difference between weak equivalence and strong equivalence is much more difficult and open to some interpretation. So in the paper, we propose 3 different ways of assessing strong equivalence that are based on decomposing consumption responses into the various forces, the various prices and policy outcomes that affect household consumption behavior. One based on just thinking about differences between general equilibrium and partial equilibrium effects. And one based on exploiting the fact that fiscal policy is neutral in the representative agent economies because of Ricardian equivalence, and asking about how responses depend on fiscal rules in a heterogeneous agent economy. So let me show you some examples. I'll say that in all cases, whenever there is weak equivalence, whenever there is a lack of strong equivalence, when the mechanisms are different, it always comes down to these same things, that the difference in responsiveness of consumption to income versus interest rates, and in the 2 models, is really what drives the difference even in the aggregate outcomes. Okay, so let me show you an example of weak equivalence. I don't have to go into few details. The top right panel shows an example of an impulse response function in the 2 models. You see they lie exactly on top of each other, at least for all intents and purposes. Focus on the bottom 2 panels. These show impulse response function decompositions. The right panel shows it for the representative agent economy. That red dashed line, that's the effect of the interest rate. What that shows is that the impulse response function of consumption is really driven by changes in interest rates in the representative agent economy. In the heterogeneous agent economy, the red line is interest rates again. The blue line is the effect of household labor income. So you see that the key difference that drives the different mechanisms is the difference in the extent to which responses are driven by changes in interest rates versus changes in labor income. An example of non-equivalence is a monetary shock. There you see that the impulse response functions are different as well, but the basic idea is the same, that the effects are smaller in Hank than in rank, exactly because of these smaller interest rate responses. Fiscal stimulus provides a clear example of very stark non-equivalence between representative agent and heterogeneous agent models, both in terms of government spending shocks and transfer shocks. In terms of temporary expansions of government expenditures, the typical finding is that output multipliers are larger in Hank models than in rank models. And the key reason, again, comes down to these 2 forces. Why? Well, remember that what holds down output expansions in response to government expenditure shocks is crowding out of consumption. The deficit finance expenditures have to be borrowed. That pushes up interest rates, which pulls down consumption, crowding out some of the effect. That force is much weaker in Hank models for 2 reasons. Why? Firstly, because the increase in interest rates, consumption is not as sensitive to that movement in interest rates. Secondly, the aggregate demand effects that increase household labor income, which don't have a large effect in representative agent models, they increase consumption in the heterogeneous agent models, again, offsetting some of the crowding out of consumption. Okay. Okay, so Hank, and those are kind of standard models. I want to spend the last few minutes talking about some questions that you can't study without thinking about household heterogeneity. So some, in the set of papers that I described at the beginning, a number of them were basically delivered to provide what I'll call micro foundations for shocks that in representative agent models we can only model as a shock to household patience. So those are things like the availability of credit or the rise in uninsurable risk. At the macro level, both of these shocks look very, very similar to a change in discount factors. But across the household distribution, they look very different. So I'll show you a picture of that. The other types of questions that Hank models can answer is to think about how different shocks affect differentially different people at different parts of the wealth distribution. So let me illustrate that with a monetary shock, just to kind of highlight this point that whether you like it or not, an aggregate monetary shock is not distributionally neutral. So on the left panel, what I've plotted here is for different percentiles of the liquid wealth distribution, going from the people with the lowest wealth to the highest wealth, what the overall effect of a monetary, this is a contraction in monetary policy shock is on household consumption. Okay, so that flat part in the middle, those are the hand-to-mouth households. That's the massive households that have zero liquid wealth. They have the highest effect. Why? Because they have high marginal propensities to consume, and in these models, it's these indirect effects through increases in labor income that affect their consumption. The people on the left, those are the people who are borrowing. There's some people who have high responses because they ride on a borrowing constraint, and then some people interior on an Euler equation. As we go up the liquid wealth distribution, households, the MPCs get lower, and the probability of hitting a constraint at some point in the future goes down, and so the intertemporal substitution effect slowly kicks in up until about the 80th percentile, where you can see that it's almost getting up to the effect of the hand-to-mouth households. That's related to a neutrality result that some people have pointed out. But then at the very top of the distribution, it starts to come down again. That's the wealth effect, because there's a bunch of households who are very rich, and they don't like it when we lower returns on their assets. The right-hand panel shows that the different forces, the mechanisms are very different for different people at different parts of the distribution. So whether you think that the effects on labor demand through general equilibrium are stronger than the intertemporal substitution effect, doesn't just affect the overall effect, it affects which of the households are going to respond to those changes in shocks. The second second sort of question where this type of analysis I think is extremely useful is for trying to use the cross-sectional responses to tell us a little bit more about the source of an aggregate shock. So what I've plotted up here is 3 different types of shocks that people have used as a negative demand shock in the last 10 years. So one is the red line is a preference shock, a shock to the household discount factor. The black line is an increase in the dispersion of idiosyncratic productivity risk, causing people to increase their precautionary savings. And the blue line is a shock to credit conditions, an increase in the spread between borrowing and lending, which also works the same as if you lower borrowing constraints. Each of these shocks has been engineered so that they generate exactly the same overall aggregate decline in consumption. Okay, so these are models that people have used as different micro foundations for the same sort of aggregate demand shock that people refer to. What this shows is where that consumption dispersion is impacted different parts of the wealth distribution. So you're just eyeballing that, you can see that the types of households that are affected by these different shocks are extremely different. So for example, in the preference shock, it's very equally distributed across the population. For the credit constraint shocks, it's really concentrated in the people who are borrowing, or are likely to want to borrow in the future, in the far right-hand side. Whereas in the productivity dispersion shock, you see kind of negative effects or increases in consumption for people at the very top of the distribution, and you have the biggest effects for the hand-to-mouth households, the people in that black line over that flat line in the middle there. So we see this as an important avenue in ongoing work. What we are doing is using cross-sectional differences in how consumption responded, say, during the recession, to help us tell us a little bit more about where that shock hit. And that's where one of the avenues where I see these class of models being used more generally is as additional sources of identification for the sources of aggregate disturbances. Okay, so let me conclude. I think that what HAG models provide us is different transmission mechanisms for aggregate consumption. The key lesson is that interest rates are less important and household labor income is more important. It suggests a different focus for some of the effects of central bank actions, that rather than taking it for granted that labor market will be affected, we might need to think a little bit harder about the extent to which we think labor demand will be affected. And secondly, that redistribution, because of household balance sheet and MPC heterogeneity, is a central channel through which interest rates affect aggregate consumption. Thank you very much.
Dr. Kim, please.
Okay, thank you. So first, I'd like to thank the Bank of Korea for giving me a chance to discuss this paper. But I have a tough job as a discussant because first, I'm the last discussant of this conference. And second, this is a very excellent survey of a field to which the authors, the Greg and Gianluca, contribute a lot. And also in the first footnote, they say it's prepared for the journal perspective. And that's the journal I always assign to my senior students when I was teaching at Georgetown. So it's a perfect one for advanced undergraduates and then entering the graduate students, and also it's very good for a seasoned PhDs or old PhDs who wants to get updated on the recent field. And I was told it's presented at the AA session on Sunday, 1 p.m., which is the last session. I think organized by Ricardo, and I was told it was chaired by Bob Hall. So it showed it's the state of macro now and looking forward. If you look at the subtitle, Now and Looking Forward, that's the subtitle of our conference, Present and Future. So I'll comment on that a little bit on two sides of my own experience, because it's hard to tell about the survey paper, especially technically it's perfect, and it's based on the many papers he wrote and published in top journals. So first one is a little about my academic effort, which shows the mood of the U.S. central banking or the Federal Reserve, and the second one is more importantly is on my policy work, which shows some of my frustration, which could, I think, hint, at least to me, a little about the role of monetary policy in the future, so that everybody in both academia, the present leaders and future leaders, and everybody in the central banking world can ponder about. So the paper is about heterogeneous households. In the footnote, there is a parallel work on heterogeneous firms. But on my own, and then this conference was on Friday of last week on fiscal policy, including names you can notice, and the Mark Huggett was the only contributor of the incomplete markets. So this interaction of fiscal policy and monetary policy is really important. And for me, it's this conference with the conference on Friday is a good example of how much heterogeneity of Hank models have invaded the whole macro. So now it's everywhere. On my personal research side, I worked on, in correct language, one asset tank model, tank meaning two-agent model, with Sung-Hyun Kim and Andy Levin at the Federal Reserve. I think Martin was at the Fed with me at that time. And then the paper starts from my co-author's work on international finance, comparing two different papers, both by Marianne Baxter and Maria Cruscini. The left one is the AER 93, and the right is IER in 95. There are many differences, but one key difference to me is the left one is on the complete markets, so it's like rank model, and the right one is the incomplete market, so it's a Hank, but it's two countries, so it's a tank model. So by comparing for the two papers, we try to understand the importance of incomplete markets. So in correct language, this is about the equivalence. I don't know if it's a strong or weak equivalence. And there, in international finance, they worked about the importance of the patience of the preference and persistence of shocks in analyzing or in thinking about the equivalence between the rank models and Hank models. And this I like to show because around the turn of the century, even in the US Central Bank, the heterogeneity that was a focus in terms of general equilibrium was not as much on households or firms. It's more on the international sides. And that was why the literature did not proceed as much as it should have been before the GFC, if we can correlate them at all. Second one, about the crisis, on his paper in page 10, he says that it is no coincidence that the first Hank models appeared in the immediate wake of the Great Recession when monetary policy is constrained by the zero lower bound. And I fully agree with that. And one of my favorite picture is this one on the August 2011 FOMC meeting when they first introduced calendar evidence. Yesterday we talked about the 2 or 5 basis points in the 5-minute window. This is 10 or 20 basis points when the Federal Reserve first introduced the calendar, the forward guidance about at least through mid-2013 is the exact language, and that's a big change. And during the same week, this is a cover page of The Economist about how much it changes the world. And then it's the reviving the world economy and sandbags. I'm a central banker. That was a he, then it was a she, that's back to he. And then I think Jan Berg would clearly see this because it's the original is Rembrandt. So this is pre-GFC monetary policy to me, and this is post-GFC monetary policy. And then one of the key things you need to know in these two different things, I can tell my students, graduate students, this Hank model, heterogeneous agent model with incomplete markets, that's certainly a feature you need to understand in using this, the fibrillator. So that's, I'd like to recommend everybody to read it. And then on the point about the wealth effects and distribution impacts, that's one feature, for example, by a survey paper by the Lieber and Nason on the interaction between monetary and fiscal policy, on which I will return again. And if you look at, this is mostly the macro conference, but if you look at the time series recent effort, I think one thing we can correlate with this heterogeneous agent literature is a recent work by Jun Park with a team of Korean economists about how to estimate the effects of some shock to the distribution. So most of time series is a real line to real line, but he and others are trying to develop time series from a distribution to a distribution, or a real line to a distribution. And this can be used in a more systematic way than the way we have been comparing the macro models, which was designed for the rank model. The first footnote of his paper has the Jinill speech about macro research after the crisis. And the title of the conference is The Elusive Great Recovery. So I don't know, they tried to find the illusion at the time. And then 5 recent trends or research topics she listed. The first one is influence of demand on agri supply. And the second one is heterogeneity. So it's kind of now, it's evaluated, it's considered as the second most important thing to do. So it shows us that how much macro research, or at least the central banking research, should take this seriously. And my first, the comment is about Greg's elephant in the room, because he emphasized how much monetary policy could matter for distribution in the case of the Hank models. Then I'm looking back and think about what's the rationale for the central bank independence. At least one rationale is monetary policy is working in an intertemporal dimension. Of course, that's true only in Hank model. But he forcefully showed us there is a redistribution effect. I agree that's an elephant in the room, but I'm kind of worrying that whether we are opening the Pandora's box about, that's not his job, but that's a job of central bankers here and there at the far end. And I think that's something we should take really seriously. In his slide, he said, which I fully agree, that we have to have better models to understand these consequences rather than playing dumb. I agree there 110%. And then what's the starting point for us, for the researchers? I think this is the last page of his paper. And about the optimal policy, he's listing recent efforts, some like the Niels Goneman et al., the people at the Federal Reserve System. And then I think this pointing towards the way of how we understand optimal policy in this Hank model, which was proved to be really important. So that's where the literature should go and would go, I think. Let me add with my second comment is over my own personal experience of frustration. When I was working at the Federal Reserve, we were working at the documents like the blue books and green books at that time. And my frustration is related to the first research topic by Jinill. Demand influences agri supply. So the way I summarize economics to undergraduates is economics deal with price and quantity by 2 orthogonal factors, supply and demand. And that orthogonality is the beauty of economics. That's how I tell students. But if aggregate demands affect aggregate supply, then are we losing? However, I think that if we go into the Hank model and go deeper, might be there is a room to still orthogonalize in a more the fundamental way. That's my hope, so that I can keep that my naive dream of orthogonality between some demand and some supply. So let me end with the 2 sets of typos. The first one is related to heterogeneity within FOMC in 2013. So when the Governor Lee spoke yesterday, the newspaper was talking about Korea's past experience, and then the taper tantrum in 2013, this statement of June of 2013, so it's right after the Bernanke's taper tantrum comment, and they discussed the meaning of moderate in a very serious way, of course, and then 40 billion, 45 billion. But when I was reading it through, I was looking at who voted for it and who voted against it. voting for and Boo, Bernanke, Dudley, blah, blah, blah. And then voting against the action, Jim Bullard and Esther George. And then, since the heterogeneity was so severe, they voted against it for different reasons. Why is it a typo? Before James Bullard, it should be war. So because two dissenters was so rare, even the people who are so meticulous about English grammar got it wrong. So there should have been war. And that's the first typo. I think, to me, it shows heterogeneity among FOMC members, which was more severe than usual. I think that's the rationale of the typo. The second one is I found some typos in the paper. So for future readers of this geometric perspective paper, it will be helpful for them. Thank you.
Please respond to the comments.
So thank you very much, Jinill. I really appreciate that. We've worked on the typos back then. Yeah. So let me get so I first want to react to your second to last statement, your frustration with trying to understand statements like aggregate demand and aggregate supply. I have had to deal with listening to those statements since I started working this topic. And the best thing I can tell you is to repeat what Tom Sargent taught to me in grad school, which is just think about preferences in technology rather, and it makes everything a little bit more easy to understand. So I agree. I dislike that language. When we wrote the paper, Gianluca and I went back and realized that we make statements throughout it, like aggregate demand and aggregate supply, and then we took a step back and said we don't even know what we mean by those, and now we regret writing things like that. So that's, yeah, I agree, there's frustration there. In terms of heterogeneity in firms and countries, I completely agree. There's parallel literatures, and I think they're equally important. The one thing I think you're absolutely right on is on an econometric front, how to think about time series of distributions is a first order question. So I have some ongoing work with a fantastic grad student at Princeton, Christian Wolf, and with Ben Moll on exactly trying to do things like estimating this class of models using likelihood methods, and that does open a whole can of worms of how to think about the dynamics of distributions. Yeah, thank you very much.
Thank you. We are a little bit behind the schedule. Now we have a general discussion session for 12 minutes. So if you have any questions for these two papers, please raise your hand. When you ask your questions, if possible, please state your name and affiliation and to whom your question is directed. Thank you.
Hello, this is Juan Pablo Nicolini from the Minneapolis Fed, and this is for Ricardo. So when you started, I got very thrilled because I thought you were going to tell me something about lender of last resort. I said, why is Ricardo not saying lender of last resort in the introduction? But then you did something that is not what I was expecting, and I'm still confused about it. And the question is, I guess, is related to Andy's point, which is when I see this, when I think of the lender of last resort facilities with the light of the Diamond-Dybvig model, I see a failure and I see something that would eventually prevent the bad equilibrium from happening, and then I'm happy. Here you seem to have something that puts a ceiling on deviations on cover interest rate parity, but we don't even know why they happen. So I'm not sure I'm that happy.
Yeah, I mean, it's a lending facility. I use the words lending facility rather than lender of last resort, even though in many ways they could be seen as equivalent. So it's like the discount window, which is a lending facility where you can show up and borrow. Now, what justifies those lending facilities? Well, the fact that you go to the private market and you can't borrow. And now you can't borrow because it's not that you can't borrow, it's because it's very expensive to borrow. So in that sense, it is like, so if you want a model of this, it's like a Diamond-Dybvig model, but it has to be a Diamond-Dybvig model as in a Diamond-Dybvig model with a realistic discount window where there's an interbank market, but at some point the withdrawals are the depositors are also the other banks that don't want to lend to you, and as a result you can't substitute the short-term funding, and thus it gets very expensive, and then the central bank comes in and says, I will lend to you at a certain rate that's punitive in some ways because there's some moral hazard or something, you don't want to do it before. So that's the way usually the budget thing gets discussed within the context of Diamond-Dybvig. Again, Diamond Divvig doesn't have the other banks, but you can think about them as being isomorphic to the other depositors in the sense of there's a continuum of banks, and you have to justify why is it that I want to charge a penalty rate, which in Diamond Divvig you would just lend at whatever is the efficient rate, and so why do you want to do that? The logic, I think, is similar. You are right that I didn't write a model for it, mostly because I didn't really have anything new to add. I mean, we did have a model, actually, but it basically just borrows from the models that Duffy and, which is really just a pool model of liquidity more than a Diamond Divvig, where you engage in investments and you have some withdrawals, and as in the pool model of liquidity, then you have this agent that comes and lends to you at a certain rate. So I was following more the pool than the Diamond Divvig tradition. I think that, I mean, it's certainly been done in literature to put Diamond and Divvig with a lending facility that is at a penalty rate. It's a little bit of an abuse. I think it works better with pool-type models, but I didn't really just have much to add to that beyond the fact that here I have some banks, they're foreign banks, the novelty, and they need to, they have some investors. Those investors withdraw. They have to fire sale just like in Diamond and Divvig unless they find alternative sources of liquidity. Those alternative sources of liquidity in this case happens to be the central bank. So in some ways, I understand you're not very happy in that I'm not really adding anything to those stories beyond appealing to them. The model we wrote is really a pool model rather than a Diamond Divvig model, just because I didn't have time to present the model. So again, I also didn't write the model you want to write, but it is a pool model in the type of the discount window. And I think one could write a Diamond Divvig model of that type, I think.
Thank you. Yes.
This is Marco Bassetto from the Chicago Fed, and it's a question for Professor Kaplan. So I think you did an excellent job at justifying why we need to look at these heterogeneous agent models, and that looking at them matters very much for a lot of the questions that we care about. One thing that you didn't talk at all about is the nominal rigidity side, where you're just taking quadratic cost of adjustments and completely sweeping under the rug all the potentially important questions about heterogeneity there are too, and the source of these nominal frictions. And so the question is, do you see this as an intermediate step, or do you think you trust actually that we got the sort of the right answer for these questions from these models, and that side of the heterogeneity is less important?
I think that's a fantastic question, and definitely I see that as an intermediate step. So there's a bunch of areas where nominal rigidities can be introduced in heterogeneous agent models that perhaps are very realistic and don't exist in representative agent models. So thinking about the typical balance sheet position of a household looks like a heavily invested in a real asset with a long-term nominal debt obligation. So there's a bunch of long-term nominal stickiness already there in typical household balance sheets. So those sources of nominal rigidities, I think this is absolutely the right model to be thinking about that, and stuff we've been thinking about. But this was really a first step. The idea was take the benchmark model for generating nominal non-neutrality and in macro, and introduce heterogeneity. And yeah, intermediate step for sure.
Other questions? Yes.
Thank you. My name is Sin Young Park from Asian Development Bank. My question is for Ricardo. In fact, I think some also comments raised that the fundamental reasons why the CIP sort of breaks down, and you sort of suspect that the very high increase in uncertainty and then risk aversion is really underlying, a lot of times underlying reason for this CIP breaks down. But when you provide the liquidity, what we observed across Asia, in fact, after the global financial crisis, there's a very significant rise in concentration of U.S.-dominated international debts. Not necessarily because these are actually, I think, investing in the U.S. assets, but it's really driven by the liquidity demand. And when we sort of provide this type of the swap lines, of course, needed at the time of crisis, very important, but it will provide some insurance for the dollar denominated assets, which will likely create more demand for the dollar. I think the talk, in fact, relates to the reform of global global monetary system. And fundamentally, if you're looking at these type of the global monetary system, right now the liquidity provision is to concentrate in the U.S. dollar only, and doesn't that sort of like a swap line somehow aggravate or create sort of vicious cycle of becoming more concentrate in the U.S. dollar for the liquidity provision? And I was wondering, okay, yes, it does create the cap, for the time being, but over time, if you're looking at the dynamics, wouldn't that make it much more I guess essential to have this type of swap line if you have only one focused the dollar being provided by the swaps, and that creates again concentration, and then creates more need for the swaps. So I wonder if that creates the vicious cycle.
Very good. So I agree with a lot of what you said, meaning in the sense that I think those are exactly interesting issues. Let me right away also agree with your correction. Whenever I said the U.S. assets, I should always have said U.S. dollar assets. It's all about dollar-denominated assets. Whether they were issued in the U.S. or not is not the relevant thing. It's all about whether they're denominated in dollars. So I'm very careful in the paper, but I'm pretty sure I wasn't careful in the presentation that I often say U.S. instead of USD, U.S. dollar. That was exactly the question that I raised after Andrew spoke, which is I think there's these very interesting questions of whether we have too much cross-border funding, and another version of that, again, the cross-border, the key thing is too much of institutions that are in a country where they have access to liquidity facilities in a currency who choose to invest in a different currency. And you added very relevantly the fact that that currency is always the dollar, and the dollar is very much the dominant currency. The expansion we saw in the swap lines by the People's Bank of China is absolutely about trying to establish the renminbi as an alternative to such dominant currency. And I think those are absolutely the important questions on whether we have too much and whether these swap lines in the welfare sense, like Andrew emphasized in his discussion, are the questions that I think we're going to have to answer next. I mean, at this stage, we were writing, I think, the first paper that shows even how the swap lines work, that they do work, what effects they have, and how they work. Now that we know they work, we have to start writing the theory of how the central banks interact. Are these good for welfare? Are they bad? How do they interact with what's the dominant currency? I think there's a lot of work to be done, and I completely agree with the agenda that you set out. The final thing, though, is this thing on the CIP, what's driving the CIP. I mean, I've punted on that question already, not because it raises any particular issue, I think, with any of our analysis, but just because there's an active literature on this. But I can tell you, I mean, there's basically two stories of why the CIP arises. There's a story which Andrew alluded to, which has to do with regulation. And the reason the regulation here is that for the CIP trade, the guy issuing the forward contracts has to carry the forward contracts in his balance sheet, in its balance sheet. And carrying those forward contracts in its balance sheet changes its liquidity ratios. Even more than liquidity ratios, really the capital ratios become very important in this. And so the interaction with the liquidity and the capital means that the banks that have to sell the forward contracts for the 1 week forward nowadays are very, let's say, have a big Lagrange multiplier, because selling you a forward contract really makes them bind either in terms of their capital charge or liquidity charges, and that explains some of why the CIP deviation exists. Even if it's 20 basis points, why doesn't a bank come in and sell a forward contract that takes advantage of it? Because it really gets into those restraints. So that's one set of stories. There's another set of stories that have to do with funding value adjustment, which say that part of the reason why these CIP deviations emerge is because the CIP trade is a riskless trade. If we have banks or financial institutions that have a lot of debt overhang, we know that riskless trades, it's classic debt overhang theory, the equity holders won't like them so much because this riskless trade will essentially transfer value to the debt holder from the equity holder. And as a result, a 20 basis point CIP spread is not enough to compensate the equity holder for the investment she is making that transfers out to the bondholder. So there's these two stories out there. There's models of them. I think there's even better models being written now. There isn't a lot of evidence yet in terms of which story is right. Maybe they're both right. But that's the state in which literature is. Whichever one it is, it fits completely with everything that I've said. And that's why we didn't go into detail of which one it is in that debate. But there is a very active literature on it. And beyond the positive effects that I said of the swap line, if you want to go again further, and this is where Andrew was spot on, if you want to go into the welfare effects of this, then you really have to say what's the model of the CIP and exactly what is it fixing a problem that the regulation created in the first place? Is it fixing a problem that has to do with the architecture of the financial system? That's the next step, which I couldn't agree more. And I'm a theorist myself, and it's writing the theories of those models. But this paper is just on the positive effects of what does this actually do on the behavioral responses of these agents.
Any questions?
I'm still confused. In my, what I remember from Diamond Digby, the sequential servicing constraint was key. And one of the features of that is that there was no price that made the adjustment. In here, you do have a price, and it's called the exchange rate. So I'm not saying that you should not have the liquidity provision in euros by the ECB. I don't see any reason to have this additional liquidity provision, given that you already have one. And if there is an issue of you have too many dollar-denominated assets and you have to buy dollars and the price of the dollar will go up, and then there's no Diamond Digby problem.
I mean, on the getting euros from the ECB or getting the dollars, it's all about just the relative cost of the two. And so this whole CIP business and so on is just literally about what is the effective cost that you face in terms of what you get. Now, there's an issue which is not in Diamond Digby, but which, again, is in our version, in our paper of the pool model, and so maybe that's what you're getting at, and I wasn't clear about that assumption, which is that you have to have that the long-term assets that the bank is invested in are dollar assets. Its funding initially was in dollars, but then when it goes and gets euros, say, the liquidity facility, it now has an extra new risk. So the way we do it is, again, pool a little bit. I think it's hard for me to think in Diamond Digby. It's a little easier for me to think in terms of Holmes from Tirol. But think about 2 periods as a Holmes from Tirol. You have a long-term investment. In the short-term period, you have a withdrawal. Now, getting funds in euros comes with an exchange risk mismatch between your assets and liabilities, and so comes with a risk. That risk and so is just going to have a cost to it. You would like to swap out that risk. If CIP held, it would be costless to swap it out. Because CIP does not hold, there's a cost to it. The swap line is a way to do it in a costly way. So I think about it as essentially the provision of outside liquidity in Holmes from Tirol, and you're setting the cost at which that happens. That's going to affect ex ante how much you want to invest in the first place, because it's going to affect how bad the funding risk is. And Diamond Digby is a little bit trickier, and so. But that, I've explained to you in the pool model my previous answer. This is in terms of the Holmes from Tirol model. I think the logic would be similar in Diamond Digby, but I'm probably missing something. But that's essentially how it's working. It's just the price at which you get the intermediate liquidity.
I don't think questions? Oh, yes.
다른 마이크 좀 갖다 주세요.
My question is for actually comments for Dr. Filardo. Korea does not have global bank which borrow short-term US dollar and lend long in US dollar. We don't have such global bank. Yet, the deviations from covered interest rate parity is more sensitive to those countries in Europe and Japan. So the issue here is, I think, we have dollarized debts. Foreign debts are dollarized. And with swaps, we can neutralize, immunize the dollarized debt. So, and can it do it through establishing some facility for private sector long-term cross-currency swaps? So with that, banks raise long-term wholesale funding by issuing long-term US dollar bond offshore and swap the proceeds into Korean won. Then we have foreign debt, but they are all in Korean won. So then we'll not have the CIP puzzle. I need your comments. Thank you.
Well, I see that we're over time, and so I think this is a complex issue that maybe we can discuss over coffee. But I think the key here is that the work that's being done at the BIS looking at these swap markets shows that these swap markets are actually dissociating from the spot markets, and it's this dissociation which creates these wedges. These markets are not as integrated as we kind of always assume from our textbooks, and that these swap markets tend to dry up and be less deep than the spot markets, and that's just a nature of the business, and especially in emerging markets and small, open, advanced economies. But we see even for large economies in the last 10 years, this has also been an issue. So it goes to my original point, which is we're dealing in a world where we don't have enough hedging instruments in deep liquid markets to deal with the big cross-border foreign currency flows. There are ways to deal with it. Some markets open up, but they're very costly. And so if you're a pension fund and you're trying to get exposure to Asian assets, most pension funds just won't hedge that risk, and so they probably have disproportionate investments in the sort of dollars, euros, and yen. But that's a structural issue in these financial markets. But I'll talk to you over coffee about these details. Thank you.
Thank you. We don't have any enough time for further discussion, so this concludes our session. And thank you again to all speakers, discussants, and participants. Thank you.